Canada just moved a tariff from 100% to 6.1%. That sounds like auto policy. It isn't. It's a change in leverage. And it matters because it creates something the United States has spent years trying to prevent: a visible alternative. Before going any further, a quick boundary. This is analysis based on publicly available reporting and official government statements. There's no speculation here about intent and no predictions presented as fact. What follows is about mechanisms, how pressure works once alternatives stop being theoretical. Here is the verified change. According to official Canadian statements and reporting by Reuters and the Associated Press, Canada will allow an annual quota of 49,000 Chinese electric vehicles to enter the Canadian market at Canada's most favored nation tariff rate of 6.1%. The quota is structured to increase over time. In parallel, the Prime Minister's office confirmed that China is expected to lower tariffs on key Canadian exports, including canola, to about 15% by March 1, 2026. It also confirmed the removal of certain other trade barriers on Canadian goods. Those points matter because they are confirmed. They are not projections. They are not commentary. They are the baseline facts. This also represents a clear reversal from Canada's previous position. Reuters reported that Canada imposed a 100% duty on Chinese electric vehicles in 2024, broadly aligned with the United States at the time. That alignment no longer exists. The United States, by contrast, continues to apply a 100% tariff on Chinese electric vehicles under Section 301 trade actions implemented in 2024. That U.S. tariff level is a matter of record. So pause there for a moment and line the numbers up. On one side of the border, a 6.1% tariff under a quota of 49,000 vehicles per year, with a defined structure for growth. On the other side of the border, a 100% tariff with zero market access. That contrast did not exist last year. And it is the contrast, not the cars, that changes the environment. This is where most coverage gets misframed. The debate immediately jumps to whether Chinese electric vehicles are good or bad, safe or unsafe, desirable or undesirable. That debate misses the actual shift. The shift is informational. Canada has made an alternative visible inside North America. In Ottawa terms, this is not dramatic. It's procedural. A quota with a low tariff rate is a controlled valve. It is wide enough to establish a benchmark and narrow enough to manage exposure. And that distinction matters because the political effect comes from the benchmark, not the volume. Here's the mechanism. Stated plainly, pressure tactics work best when alternatives are invisible. As long as consumers, firms, and voters cannot see a realistic alternative in practice, the costs of protection remain abstract. They exist on paper, but not in daily life. Once a neighboring market demonstrates a cheaper or different option under real-world conditions, the debate changes. Not because policy must immediately shift, but because maintaining the status quo becomes more expensive. This is not a theory. It is how trade politics behaves in open economies. The Canadian decision creates a comparison point inside North America. Canadians will be able to see prices, features, and availability that Americans cannot access under current U.S. policy. That alone does not force Washington to change course, but it does change the cost of maintaining the current course, especially in border regions and in politically sensitive manufacturing states. That matters. Now add timing, because timing is the second lever here. Under the United States-Mexico-Canada Agreement, Article 34.7 requires a joint review on July 1, 2026. The Congressional Research Service confirms that recommendations for that review are to be submitted at least 1 month in advance. In practical terms, that means the real negotiation window opens in June of 2026. Canada enters that window with something it did not have before: a credible outside option that is already operating inside its market. That does not mean Canada intends to abandon alignment with the United States. It does not mean Canada intends to flood its market. It means Canada has increased its room to maneuver at a known decision point. This is the difference between leverage and symbolism. You can see early signs of that pressure in U.S. industry coverage. Reporting around the National Automobile Dealers Association convention quoted the group's chief executive, Mike Stanton, saying that Chinese automakers entering the North American market would be bad for our industry, bad for our country, bad for consumers. That quote was reported by Automotive News and summarized by outlets such as The Drive. The quote itself is not the point. The signal is. Public alarm from an entrenched domestic lobby usually appears when a previously stable equilibrium is disturbed. In this case, the disturbance is not an immediate influx of vehicles. It is the appearance of a benchmark that makes price differences visible. It's important to stay disciplined here. Dealer concern does not prove intent, and it does not prove outcomes. What it does show is that a comparison point has emerged, and that comparison introduces political friction that did not previously exist. The Canadian government's own language reinforces this interpretation. In official releases, Canada stated that it expects the arrangement to drive significant joint venture investment within 3 years. This investment would involve trusted partners and would build out Canada's electric vehicle supply chain. The wording matters. Expects is not guarantees. This is policy design, not a promise of immediate factories. The Prime Minister's office also stated that it anticipates that within 5 years, more than half of these imported vehicles would qualify as affordable electric vehicles. These are defined as having an import price under 35,000 Canadian dollars. Again, anticipated is the operative word. This is an affordability benchmark, not a certainty. When you put these pieces together, the structure becomes clear. First, Canada created limited access at a low tariff to establish a benchmark price. Second, it paired that access with export concessions that have immediate, measurable value for Canadian producers. Third, it did so ahead of a known treaty review date where leverage matters. None of this requires assuming bad faith by any party. It requires understanding incentives. In the United States, the 100% tariff keeps Chinese electric vehicles off the market entirely. That policy has domestic support, particularly from established dealer networks operating under franchise laws. Those laws add real cost to vehicles, but those costs have been largely invisible to consumers because there was no nearby comparison. Canada just created one. That comparison does not mean Americans will suddenly buy Chinese vehicles. It means arguments about affordability, competition, and consumer choice become harder to contain. When Canadians can purchase vehicles under materially different conditions, the debate in U.S. border states changes from theoretical to concrete. That is where pressure shifts. This is also why the quota matters so much. A quota allows Ottawa to calibrate exposure while still generating the comparison effect. It preserves policy control. It signals openness without surrendering it. Canada did not remove its ability to adjust. It preserved it. There is another constraint embedded in the official language that deserves attention. Canadian statements emphasize trusted partners and domestic supply chain development. That is not rhetorical filler. It signals that access is conditional and monitored. Again, this is about risk management, not ideology. So what does Canada gain in practical terms? First, it gains confirmed tariff relief on key exports, including canola, within a defined timeline. That is immediate and measurable. Second, it gains a domestic benchmark that can influence future negotiations without requiring confrontation. Third, it approaches the USMCA review with a demonstrated outside option already in motion, rather than a hypothetical threat. What does the United States lose? Not control. The United States retains full authority over its tariff regime. What it loses is insulation. The ability to argue that protectionism carries no visible alternatives weakens once a neighbor demonstrates one. None of this implies inevitability. It implies changed math. Policy outcomes remain contingent. Congress can act. Administrations can adjust. Courts can intervene. But all of those decisions now occur in a landscape where alternatives are visible and politically salient. There is a tendency to frame this move as a geopolitical tilt toward China. That framing is incomplete. The policy architecture points to a narrower intent. Diversify options, attract investment under conditions, and increase room to maneuver ahead of known decision points. Canada did not abandon alignment. It added leverage. The evidence supports that conclusion. Official Canadian statements emphasize expectation rather than certainty, control rather than openness, sequencing rather than shock. U.S. policy remains unchanged. The shift is in relative positioning. At this point, it is also important to say what this does not mean. This does not mean the United States is about to reverse its tariff policy. It does not mean Chinese electric vehicles will suddenly dominate North American roads. It does not mean Canada has surrendered control of its market. And it does not mean outcomes are predetermined. What it means is that pressure tactics have become more expensive. And in geopolitics and trade, cost is often the decisive variable. As the July 2026 USMCA review approaches, the key question is not whether anyone escalates. The question is whether alternatives remain visible and credible. If they do, leverage holds. If they don't, it fades. That is the line Canada drew. Not with a declaration, not with a speech, but with a calculation. And that changes the math.